It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. This is Managing Your Financial Future. I'm welcoming back... What's your name again?
You gave me a week off. You forgot me already, huh?
Well, you were not available, and I would have given you the week off anyway. I was trying to think, Professor Plum, yes, is you, CFP.
Oh, that's me, yes.
CFP professional, John Dean, you're
non-advisor host.
Non-advisor, so that's why you're here. But we didn't really give you the week off. I know you had to wait. You had to be home for a plumber or something.
Oh, is that what it was?
Yeah, I think that's what it was. Yeah,
it's been a while.
It has been a while, but anyway. So I've got you back. We had Chris Lloyd, who's also a CFP professional, on last week. I hadn't had him on for I looked. It's just over 3 years.
Wow.
So
it's always good to have him on.
Every 3 years we have to have somebody on besides you. I guess I don't know. But anyway, welcome back to you.
Thank you.
Nice to have you back here.
I don't have that down home Southern charm that he has.
You don't have that Tennessee. You don't have that Tennessee drawl. It's not even a drawl. I'm not sure what it was.
Comfortable talking to him.
It's like Tennessee Comfort. Is that something people drink or what? Southern. I won't get into that. But anyway, you are a CFP professional.
Yes.
I'm still trying to figure out how I have to say that. Certified financial planner, professional, whatever. We've gotten questions. We get questions, and the thing is, sometimes we record these in advance, a couple weeks in advance, and we will get emails about topics that we've talked about, like 2 weeks or 3 weeks after we did the original thing. I have to go back and see, well, what were we talking about? And we had some questions about Roths. Now, there was a podcast we did a little while back about Roth 401k versus regular 401k, and we do talk about Roth IRAs from time to time. And I think we said it on the show, but I'm not sure if we did. I will repeat it. The Roth is 25 years old.
This year, yes.
In 1998. So first of the year, 1998.
So it's the 26th year we could use one. But
It's
yeah, we started having the ability to convert to or contribute to Roth IRAs in 1998.
Right. So the Roth IRA is, I can't believe it's 25 years old. Somebody said, hey, a Roth can rent a car now. I thought that was funny. But a Roth IRA, the Roth seems new to me still. I don't know why.
They've been around most of your working adult life.
Well, think about some of the people that have been in the business who are just starting in the business. They've always known a Roth IRA.
Right. I mean,
and they've been around for a long time, and they're a part of the plan, a big part of the planning process. And I read a stat, and I don't have this. I'm paraphrasing. But it was something like 65% of adults have no idea what a Roth is. I mean, they've heard of it.
Well, I think
but
there's
they
also
don't know what it is.
That 50% or more don't have any retirement savings at all.
Well, that's that. I'm sure that goes hand in hand.
That's a big percentage of the people that don't know what a Roth is because they've never had to have the conversation of, well, I have this retirement money. What should I use? They don't have any retirement money.
Well, if you bring up a Roth, to people, you might as well bring up a SEP or a Simple. I mean, to them, it's to people who don't understand what it is.
Up until next year, those things are very different.
Well, no, that's
They're
true.
kind of opposite.
Yeah. Well, exactly. So I wanted to devote some time here to, I don't want to say clear up Roth confusion, but at least sort of go over again what a Roth is, because even people who listen to podcasts like this, many of them already know what it is, but many don't. And if you know somebody who doesn't know about this stuff or could use a little refresher course, maybe send them the link to this podcast and let them know that we're going to be talking about it here today. Roth IRAs, well, any IRA can be confusing because there are tax aspects to it, there are tax-deferred aspects to it, and then there are tax-free aspects to it.
Right. And every time they change the laws, they make things a little more complicated.
Sure.
I mean, back in the old days, an IRA was one type of an account. It was all pre-tax. It was all tax-deferred. And then they took away our ability for many people to deduct the contributions. So
was it all originally deductible too?
It was federally, but not at the state levels yet. So there were some different basis information for state and federal.
Yeah.
But talking from federal only at this point. Yeah, at first they were deductible, and then they took away our ability to deduct if you were making more than X amount of dollars. And So then that became a little more complicated. Do I have after tax and before tax money in my IRA? How do I get the money out? They had to come through and basically sort all that out. And so we got that straightened out. And then that IRA tree that basically had no branches, but it had different, flavors of whatever inside of pre-tax and after tax. Now all of a sudden in 1998, they made a big branch. So it became two big trunks. Now one side of it was the traditional IRA, and the other side of it was the Roth IRA. They're both IRAs. They both have some similarities. I mean, basically they have the IRA in the name, but their tax treatment was kind of opposite.
It's the Roth is almost the traditional IRA inside out, turned inside out in many ways.
In the most basic terms, yes. I mean, with a traditional IRA, normally we get a tax deduction for putting the money in.
Yeah,
we don't with a Roth. So there's basically three steps. There are three phases of an IRA. There's the money that goes into it. There's the deferral period, and then there's the money coming out of it. Those are the three basic areas. So you've got the money going into it in a traditional IRA. Typically, if you're doing it, you're trying to get a deduction for it. Then in the middle, it grows tax deferred. And at the end, the money comes out taxable. Well, you take the first and the third steps in that thing with a Roth IRA and flip them around. No tax deduction going in, still get tax deferral. But if you live up to the rules, pulling the money out is tax-free, which is the money going in, the exact opposite. One gets a deduction, one doesn't. The money coming out, one is taxable, one is not. Again, once you assume that you lived up to the rules.
Yes.
And you're not facing any penalties and all that. I mean, even taking money out of a traditional IRA, if you do it too soon, it's going to have penalties.
Yeah. Now, inside a Roth, it acts because it's an IRA. If you're selling things and buying things and doing different things
during that deferral period, it's all the same as a traditional IRA. It's tax deferred. You don't have to report your capital gains and losses. You don't have to report your interest earned or anything of that nature. You just let it chug along. There's very few things that you can do inside of an IRA that create a taxable event, but there are a few. And the ones that are taxable inside of a traditional IRA are taxable inside of a Roth IRA too.
Sure.
But they're small little things. Don't worry about that. But basically, yeah. So the question is, what do you value more? The tax deduction up front or the tax-free income later on? Now, the nice thing about the Roth is when you do take money out of it later on, after 59 and a half, after 5 years, it doesn't show up on the tax return. It doesn't affect your taxability, your Social Security. It doesn't affect the IRMA. It doesn't affect anything that is set on adjusted gross income, modified adjusted gross income, any of those levels, because it doesn't show up. Unlike tax-free municipal bond interest. Tax-free, I don't have to pay taxes on the interest that I receive on a municipal bond. But it's on the tax return, and it does affect the taxability of my Social Security. And it does affect my income-related monthly adjustment amount. It does affect other things, even though I don't have to pay tax on it. The Roth is super clean.
Is
it
the
doesn't
Roth
affect anything?
Would you say the Roth is invisible pretty much across the board
On the tax, yeah.
Once you've satisfied the rules.
Once you've got what they call a qualified distribution. Qualified distribution means you've had Roth IRAs continuously for at least 5 years.
We'll get to that in a sec.
And you are at least 59 and a half, and you're taking the money out.
When we say 59 and a half, we mean to the day.
To the day. Not the year you turn 59 and a half, the day.
And I say that because my wife will forgive me for mentioning this, but she turned 59 and a half yesterday. And
happy birthday, Chris.
So we've got a Roth that we've been.
You have access to money that you didn't have access to before without a penalty.
We didn't, and we're waiting an extra couple of days just to be clean. but and this is what made me think of this too, because I said, oh well, you know what, you can take it out. She says, well, how do I know what was my contribution? I said, it doesn't matter.
Now it doesn't matter.
It doesn't matter. So she's like, well, wait, so I can take X thousand out. No tax.
As long as you have X thousand in there.
Well, because she's used to doing that. We've taken we've moved money from her 403B into her into our personal account. But we paid taxes. We had to take more out for taxes.
Okay.
Right. So we've moved from the 403B into that. So she's like, well, so we don't have to gross it up and then net it. No, we don't have to do that. It's all tax free.
Yeah. Prior to 59 and a half, there's certain. Whenever you're dealing with an IRA and you're taking money out of the IRA, you have to first off, is it a traditional IRA? Is it a Roth IRA? If it's a traditional IRA, for most people, it's pretty straightforward because most people that I've run into don't have after-tax money in their traditional IRA.
Yeah.
But if you do have after-tax money in the traditional IRA, then you've got a specific set of rules on what is and what is not taxable when you take a distribution. Well, the same thing works. I mean, you still have this specific set of rules for Roth IRAs, but they're a different set of rules for
so
Roth IRAs
let's
than
talk
it is
about
for a
that.
traditional
Let's
IRA.
talk about that. A question that we got from somebody was a couple of questions, actually. When can I get to my money? We're talking about your
So we're going to talk
contribution.
Roth IRAs only.
Yeah,
This is
Roth IRAs
everything
only.
going forward right now is going to be talking about Roth IRAs.
Right,
We're,
right.
We're ignoring traditionals.
Correct. So when can I get to my money? And by that, I mean
Define your money.
contributions.
Well, contributions can come out at any time for any reason, whatever, and it's not taxable and it's not penalized. That is a big difference between other accounts. But this is a nice thing with Roth IRAs. It makes them very flexible. And for when they first came out, for some people that were having troubles, because the idea is, especially when you're starting off, you need to have an emergency fund, but you need to start saving into your Roth. You need to build that systematic. You need to build that discipline. But I got to get my emergency fund first. Well, do it inside the Roth because you can always get to it.
Sure.
And if you don't need the emergency, at least you got the contribution and they're working for you. But yes, your contribution, money you've taken out of your pocket and contributed, currently up to $6,500 for 2023. Some states still have the ability to do 2022 Roth contributions because even though we're past the April 18th deadline.
Oh, you can still do it for the state?
Yeah, for most of California, parts of Georgia, parts of Alabama, we are in those disaster zones.
Oh, just for this year. Yeah,
for this year. We have
because our tax return isn't due until October.
Yeah, we've got an automatic extension. Normally, you have to fund an IRA, whether it be traditional or Roth, by the due date of your tax return, not including extensions. But this crazy extension they gave California, most of California, and then the other two parts of the other two states, they just said everything's extended until October 16th going forward.
So, all right. So you keep
the money you can contribute. You can take that back at any time, for any reason. Now,
and if you want to know what you've contributed, it'll be on your statement. It'll tell you what you're
maybe or maybe not.
Oh, well, mine is, but okay.
You keep track of your contributions.
But keep track. Yes, because the first money you take out will be that.
Now, when you take the money out of the Roth IRA, that Roth IRA provider is going to issue a 1099-R, and it's going to say taxable amount not known. They don't know what your basis is or isn't. They don't. They're not going to suppose that this is your only IRA, your only Roth IRA. They only know that you took money out and you're not 59.5. So they are going to issue a 1099 that says John took out $10,000 and the taxable amount undetermined.
Again, this is for somebody who is under age 59.5.
And so what you have to do on your tax return is file a form, 8606, where it says, yes, I took money out of my Roth IRA and my basis was $50,000. You've been contributing for a long time.
Apparently. Wow.
So I took 10 out, and then my remaining basis is 40. But because I took basis out, none of it's taxable. But you do have to account for the distribution. It won't be taxable if it's just your own contribution coming out.
But you have to let it.
But you do have to, because you are going to get a 1099. And so the easiest way to get a letter from the IRS is to not report income on your 1040 that's been reported to them. Even though it's going to be tax free ultimately, if you get that 1099, it's like if you do a Roth or IRA rollover, you do a 60-day rollover. You pull $50,000 out of your traditional IRA, and within 60 days, and you live up to the once every 12 months, you put it back in. It's a non-taxable event, but you're going to get a 1099 that says you took money out of IRA A. IRA A doesn't even know that you put it into IRA B. They don't. So if all you say is, well, I know it's not taxable. If you don't put that 1099 on your tax return and show it as non-taxable, you're going to get a letter from the IRS.
So you can get to your money before age 59.5. You get to your contribution. Now let's talk about after age 59.5. Well, we just talked about it. You said once you're 59.5, they won't even send a 1099. I suspect,
or they'll send one saying it's a qualified distribution, but
because they know it is
right. But not they don't.
Well, they don't know how long you've had a Roth. Maybe if you've had a Roth with that company for many years,
right? And so there's three potential types of money in a Roth IRA. There are your contributions. There are converted amounts of money that was at one point in a retirement plan, an IRA, a 401k, or something of that nature, and you converted from a traditional IRA, 401k, or otherwise into the Roth IRA. You paid taxes at that time. So it's after-tax money. But it has a different characteristic. It's not money you contributed. It's money you converted. And then there are earnings. So the three types of money are contributions, converted principal, and earnings.
Sometimes people do not have converted principal.
No, if you didn't do a conversion, you don't have a converted principal.
But you will have
and sometimes people don't have contributions. They only have converted principal.
True, yeah.
So those are the three potential types, and hopefully you have earnings. Not everybody has earnings.
Well, if you've had it in for a long time, you probably have something.
Hopefully you've done something.
Yeah, I would hope so.
But those are the three different types of cash or assets, or three different categories of money that are potentially in a Roth IRA. And each one has its own set of rules for the taxability of it if you take it out before 59 and a half and before certain other issues like 5 years. So the contributions are the easiest. If you've made contributions cumulatively over however many years you've been contributing, that money can come out anytime, any reason, no fuss, no muss. Just account for it on your tax return and be done with it. It's your money. You can do anything you want with it. I don't think you should take it out unless it's an emergency, but leave it in there to grow. But that can come out. The next money that comes out, if you are trying to pull money out of a Roth IRA and you're not 59 and a half, is converted principal. And so they're going to look at that converted principal and say, okay, they've taken out all their contributions. Now they're getting into the money that they've converted over the years. And the first money coming out is the earliest conversion. So maybe I've been doing conversions every year for the past 5, 8, 10 years. The first money that comes out after my contributions are done is the money I converted the furthest ago, the longest time, the longest.
Yeah.
And that has an issue because if I take out money that I have converted within the last 5 tax years, I'm going to be subject to a penalty. It's not taxable because I paid taxes at the time I converted it. But if I'm taking out, I've already taken out all my contributions. I've already taken out any money, if any, that I converted prior to 5 tax years ago. And now I'm taking out converted principal. So I did a big conversion in 2020, and now I want the money out. It's 2023. Well, I don't have any, I haven't done any contributions. If I've paid tax on it, why? I paid tax when I converted it. But if I pull that money out now and I'm not, I'm going to be hit with a penalty because it's an early distribution.
You haven't taken it out.
I haven't waited long
5
enough.
years. Yeah.
You have to wait 5 years to get that converted principal out. Now, if you have exhausted all your contributions, you've exhausted all your converted money, even the newer converted money, and the only thing left in the Roth IRA is earnings, and you aren't 59 and a half, or it hasn't been 5 years, now if you start taking money out of earnings, it's taxable. Yes, this is a Roth we're talking about. You take it out before 59 and a half, those earnings will be taxable and penalized. So that can be a little detriment. Leave those in until you're at least 59 and a half and have 5 years under your belt.
If you're over age 59 and a half and you have converted principal that isn't 5 years old, the 59 and a half doesn't matter?
No, the penalty for early distributions, regardless of where the characteristic of the early distribution
so I could be 65 and still potentially be penalized.
I did a conversion at age 58. I converted, for whatever reason, I converted $100,000.
Yeah, okay.
And then at 60, I have no other Roths. I've never done anything else. At 60, I want to pull some money out. I can pull that converted principal out because I'm over 59 and a half. I do not have to pay a penalty on it because I'm over 59 and a half.
Okay.
Now, if I put that 100,000 in and it grew to 120, and it was 58 years old when I did it. It was my first Roth IRA. It's the only thing I've ever done in the Roth world. And I pull the money out, I won't be penalized. But that 20, if I just exhaust the Roth, take all 120 out, that $20,000 of earnings that come out will be taxable to me. Why? I'm over 59 and a half.
You haven't had it,
but I have not had the Roth for 5 years. And even so, I don't owe a penalty on it because I'm over 59 and a half, but I will owe taxes on that.
These rules just get...
But the rules are straight.
They are, but you have to follow them. I mean,
darn it. Well, those darn rules I have to follow?
Well, I mean follow the rules, but I also mean you have to follow what's going on here. I mean, you have to be able to hear this
know
and
what's
say,
going on.
Well, wait a minute. Why a Roth should be simple. Why is it...
It is simple.
Well...
Conversions, you got...
It is and it isn't, though.
It's just...
It is and it isn't. And I'm speaking to the people who don't really even understand so much what a Roth is.
A Roth is a savings... Another miscommunication that I've seen a lot, or misunderstanding with IRAs in general, Roths in specific, is that a Roth, they think, a Roth is an investment. No, a Roth is an account. It's a type of ownership. It is not an investment. Now, once you've put money into that account, into that type of ownership, you can invest it in almost any way you want. You can keep it very safe in cash. Probably not the best idea, in my opinion. You can put it into stocks. You can put it into bonds. You can put it into gold. You can put it into almost any. You can put it into almost any investment, and then that's the account is the Roth. The investment is inside the account.
Yeah, and the Roth characteristic of it really
is the account rules the taxability.
Who can contribute to a Roth? Let's talk about that here for a moment.
First thing you have to know is that you have to have earned income. Retirees, no job. If you're unfortunately between jobs and you don't have a job for the entire tax year, you have to have earned income, wages, W-2 income, self-employment, profit.
Yeah.
Just because you're self-employed, a lot of self-employeds, they write everything off and they
wind up with a loss.
With the loss, even though they've got cash in the bank. But you have to show a profit on your self-employment to be able to contribute to it. So the first rule, like any IRA, is you have to have earned income. Or, in the absence of that, you have to be married to somebody who has earned income and you file a joint return. So if I have a non-working spouse or if I have a retired spouse and I'm still working or they're still working, whatever, as long as there is earned income on that tax return. If you're a single person, it's got to be your earned income. If it's a married couple, there's got to be earned income between the two of you if you're filing a joint return. Can't do this separate.
Let's say I'm a 45-year-old, and my spouse is not working.
Right.
Okay.
And
I'm making less than the amount. What is it now?
You get the sheet.
Doggone it.
Well, the first thing is you can contribute 100% of your earned income up to the annual limits. This year, the annual limit is $6,500 for everybody. And then $7,500 if you're 50 or older.
Right. So if I have a non-working spouse, and I can make a contribution for me because I'm working and I'm under the limits,
and you can make a contribution
I can make a contribution for my spouse who is not working.
Right.
But I could do, let's say I'm 45, I could do $6,500 for me.
Right.
For the current year, and I could also do $6,500 for my spouse, even though my spouse has no income.
And that's in theory.
But I have to be filing a joint return.
Filing a joint return to do the spousal one, and you also have to have a total household income, adjusted gross income on a joint return under $218,000. So if you have a joint income over $218,000, you start losing the ability to contribute directly to a Roth IRA. So if you're right at 218, if you're okay. If you're at 218,001, you're okay. But as you go above 218, you start losing it. So if you're and then once you get to 208 or
28, I think it is
228, that's when you lose the complete ability. So it's a phase out over that $10,000 range. If you're $3,000 into it, you lose the ability to do 30% of the limit. And I can't do the math quick enough.
No, but there's a phase out. There's a phase out, but yeah.
For a single individual, it's 138 to 153, a $15,000 phase out. Why? I don't know. Congress wrote it. But so you have to have earned income, and you have to have total household income under the threshold. Now, total household income is wages, IRA distributions, pensions, Social Security, net positive real estate, capital gains, interest, tax-free interest. All these things go into the magi for determining whether you're over the limit for contributing. It's not just your wages. You don't just look, I'm working, but my spouse is retired. My spouse has got a $90,000 pension, and I'm making, $200,000. But I'm $200,000. I'm under the limit.
Or if you're making $100,000, but you have $120,000 of rental income, or $130,000
net positive rental income.
Net positive rental income.
Yeah, you're over the limit.
You're over the limit. Yeah. Okay. So that's who can contribute to a Roth. So you can use your spouse's earned income
if you file a joint return
by filing a joint return. The other question.
Now, this is the 25th anniversary we've talked about. When we first had the ability to do Roth IRAs, we had people that wanted to convert from traditional IRA were limited. If you made $100,000 or more, you could not convert.
And that was married or single, I think.
That was, single or married. And it's married filing joint, 100. Single person, 100. Married filing separately, 0.
You couldn't
don't do it.
Yeah.
But that was in 1998. And at that time in 1998, if you did a conversion in 1998, you got to spread the conversion out over 4 years. That was just to try to wet your whistle.
You got to spread the taxes that you paid on the conversion.
You got to spread the conversion and then calculate your taxes. So if I did a $100,000 conversion, I showed $25,000 of taxable event in each year for 4 years.
Which is spreading that out in your. You could do it all at once.
I don't remember that too much, but
no, you couldn't.
I don't remember doing that. I thought it was spread. Now we're going back in ancient history. I'm sorry. I'm not going to.
I don't know if people may not be interested in this, but it seemed to me that at the time, because they
choose.
wanted people to do Roths, so you had 100,000 you wanted to convert. You could convert 100,000, but you would put 25,000 in each
the next 4 years
because people got stuck. They converted their big .com gains. They converted $100,000.
And left it in the .com. And it looked great for $98.99, but then in 2000, their 100,000 turned into nothing.
Paying taxes on something that was.
But you
lost.
had to spread it. I remember that.
You definitely had to spread it. You're correct. Yeah,
that's why they said you could choose to do it all in 1 year. But
no.
But then they weren't getting enough conversions, so Congress in 2010 said, "Let's take off that silly $100,000 limit. If you want to convert, you can convert. Anybody. If Elon Musk could convert." Bezos can convert. Anybody, regardless of their tax return income level. You don't have to have earned income. Yeah. You don't have to have income. It doesn't matter what you're doing. If you have an IRA, 401k, and you want to convert it to a Roth IRA, go ahead. If you're making $22 billion a year already, what's another, tax on the rest of it?
Yeah. Go ahead.
Anybody can do Roth conversions. And this is a big misnomer too. A lot of people that are retired, we talk about doing Roth conversions, and they say, well, I can't do it anymore. I'm not working. Well, no, you cannot contribute anymore because you're not working, but you can convert. You can always convert. There is no age limit, and there's no earned income limit.
Okay, so the final part of this is we talked about you're over the income limit. You cannot contribute directly to a Roth IRA. The oddest thing is what they allow, something called a Roth two-step. Now,
well, I think it was unintended to begin with.
Well, they know about it now.
Right, and they've actually
allowed it.
Embraced it.
They still allow it. So explain, if you would, please, for people who would love to get money inside of a Roth, but they don't have a way to, they cannot directly contribute. They can do something called the two-step.
So we've always had this limit on who could contribute if you're making too much money. Mm-hmm. It's all the way up to $218,000 now. It was a much lower, 15, 18, 20 years ago. But in 2010, we talked about they took the limit for converting money away. So anybody could do a conversion. And one of the unintended consequences of that rule change was that now people who previously could not contribute directly to a Roth IRA could, in theory, contribute to a traditional IRA, because there is no AGI limit for contributing to a traditional IRA. There is an AGI limit for deducting the contribution to an IRA, but there is no limit for contributing to an IRA. As long as I have earned income, I can contribute to an IRA. So I could do a contribution to a traditional IRA, and typically for people that were over the threshold for the Roth limit, they were definitely over the threshold.
Oh, they were.
Assuming they had a retirement plan at work. Mm-hmm. So they were going to make a non-deductible contribution to a traditional IRA, and now we have a traditional IRA. And anybody at any age group of any income level can convert traditional IRA to Roth money. So they just turn around and convert that to a Roth.
So the two steps, they want to they want to put $6,500 into a Roth. They make too much money, right. So they take this $6,500 and they put it into a non-deductible traditional IRA, which they can do.
Well, even if they want to deduct it, it works out.
Well, but
fine.
let's just say they make too much money at this point because they can't contribute to a Roth.
The first step is contribute to a traditional IRA. Mm-hmm. The second step, Roth two-step, convert.
Turn around and convert that and put it into a Roth.
Now, this works really well if you do not have any other IRAs, traditional IRAs, no rollover IRAs, no contributory IRAs, no other IRAs, no SEP, no
traditional type,
no traditional type IRA. Because if you have those other types of IRAs, you have a rollover. Well, I don't have an IRA I contributed to, but I got this $1 million rollover that I retired from XYZ company and rolled my 401k into an IRA. that's going to cause a problem, because the idea is if we have no other IRAs, maybe we have a 401k, we're contributing to the 401k, we want to save a little more into the Roth world. We put it into a traditional IRA, but we cannot deduct it. So I put my $6,500, $7,500 into the traditional IRA, and I don't get a deduction. And then I convert it over to a Roth. But because I didn't get a deduction for it, it's after-tax money. And when it goes over to the Roth, I don't have to pay tax on it. So it's a very clean way to do it. It looks like I'm kind of contributing to the Roth, but I'm not. There's a stopover in a traditional. However, if you've got a bunch of after or pre-tax money in traditional IRAs, and it doesn't have to be that account, it's any account in your name. You could be at, one could be at Charles Schwab, one could be at Fidelity, one could be at Vanguard. This one's at your bank. And you say, well, I know that the $6,500 in this account here is 100% after-tax money. IRS doesn't care. They look at your entire IRA world. You've got all these different IRAs, and they add up to $1 million, and you've got this other little one for $6,500 that's after-tax, and that's the only after-tax money you have. You're not going to get a clean tax-free conversion.
Yeah, you can't.
That's the problem. But if you have no other traditional IRAs, it's a great way. I know people that have been doing this since 2010. They've been over the wage limit ever since 2010. So for the past 13 years, I don't know what the total amount they've contributed. They've got decent-sized Roth IRAs now.
It just seems dumb. Just let people just take the contribution limit away.
Well, then, but the problem, we won't get into the problem. But so now it's just a matter of understanding what you have, how to do it. Mm-hmm. And once you get to 59, then there are, unfortunately, some complexities. There's 2 sets of 5-year rules. There's a rule for the penalty. There's a rule for the earnings. And so when you talked about it's complicated, it is complicated.
It is complicated.
But you just have to follow the rules. And the rules are not that bad, but they seem onerous.
But the Roth could be a powerful tool.
Oh, it's a great tool.
But you got to know what you're doing, is what we're saying. And I think it's important when again, it comes back to the uses of using somebody who knows what the tax consequences of doing all this stuff are. An advisor who understands this kind of stuff.
Yeah, I think Roths are cool. I mean, they're great. You just have to know what to expect and how to use it. And every once in a while, we'll run into somebody who started a Roth and it's been sitting in cash for 10 years because, well, I forgot to do something with it. Okay, you took the step of actually contributing to it. Make the next step of help. Let it help you. Let your money help you.
Help me help you, or whatever that phrase is. Yeah, exactly. The services of a financial advisor can help you out. Rick Plum happens to be one of those. Certified financial planner, CFP professional. Certified financial planner professional. I've got to get that right. Is it CFP?
Well, we know if we say CFP, you have to say professional.
You do have to say that, yes, because there's a little registered trademark.
The question is, if we say certified financial planner, do we have to say professional after that?
I don't know, but I'll cover my bases.
This is called Compliance 101. And
I don't know.
It's the hard part.
I don't know. Anyway, it doesn't matter. You work here with Lucia Capital Group, and this is the kind of stuff that you guys do all the time. There are people who may contribute to a Roth that say, well, heck, I've heard they're tax-free. So I put it in 5 years ago. My $5,000 has grown to $10,000. I'll take the whole thing out, and I'm 40 years old. How about that?
Nope.
It's going to create problems. So you still, as basic as the Roth sounds, there are still complicated rules that need to be followed. But if you follow them, the rewards, if I want to put it that way, can be great.
And they can work really well for other areas, not just retirement, younger people, first-time home purchase, things of that nature. There's rules. Got to follow the rules. But it's a great way to potentially build up some amount of down payment for that first-time home purchase, as long as it's been 5 years.
You want to put your Roth to work for you? Check with the folks at Lucia Capital Group, 800-644-1150, 800-644-1150. Roth is 25 years old, but a lot of people still don't know exactly how they work. And don't take a chance. It's better to have somebody who knows what the consequences are for doing various things within the Roth. 800-644-1150. Also go online, LuciaCap, LuciaCap.com. Find all this information there. And download our podcast, Spotify, iTunes. We're on both. You can subscribe. I would highly, as I do every week, highly suggest that you subscribe. And it's always a learning experience. Even I learn stuff. I've been doing this for how many years now? Decades. And I'm still learning stuff.
Well, I still learn stuff, mostly because they keep changing stuff.
Well, that's
on us.
it. You have to stay on top of it, don't you? So subscribe to our podcast and just become one of our regular listeners. You can get in touch with us through Lucia Cap as well. LuciaCap.com. Send us an email. Tell us stuff you'd like us to talk about, and if we can do it, we will absolutely do it. Out of time. Thanks again, Professor Plum. Welcome back.
Thank you.
Yes, we'll have you back next week, and maybe another advisor. I don't know. I'm working on that. Trying to get this season at least 2 or 3 more advisors on to talk about their experiences and things that they think are important.
Stay home and get more work done in my house.
I'm still going to have you in. Yeah, more plumbing. All right, out of time. Thanks again for Professor Rick Plum. I'm your podcast host, Johnny Dean. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Case studies, examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Municipal bond interest may be subject to the alternative minimum tax. Rick Plum and Chris Lloyd are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.